Good morning, everyone. I'm Martha Stokes. I'm a retired chartered market technician, and I like to share my thoughts and ideas with you. I was listening to the news over the weekend and retail news, not the professional news. Professional news comes in the email through to me, so I know what's going on the professional side. The retail news was saying Main Street versus Wall Street, and I'm going, ugh, are you kidding me? That ancient stuff. It is no longer Main Street versus Wall Street. It hasn't been for decades. There are 14 separate, distinctly different market participant groups. It is called the market participant cycle, and it is a cycle that is perpetuated constantly. It can be a day, a week, a month, a year, 2 years, 5 years, 10 years. It is always the same as far as who is trading when and what and where and why. So if you're constantly assuming that it's Main Street and everybody's picking on the little guy, you have the wrong impression. Most of the time when you retail trade, day trade or swing trade, you are trading against either small funds managers who have less than 5 billion assets under management and are not considered professionals because they have no professional credentials. They're either a franchise or they have a small fund that they're building up and I have $1 billion. It's such a big deal. It's nothing because the giant buy side institutions that you often call dark pools have trillions of dollars under assets under management, trillions and trillions, some 250 to 300 trillion assets worldwide right now, probably higher because of all the speculation is going on. So we start the cycle at the bottom. This is a very good chart to study this with. This stock had been in a sideways and downtrending. Actually, it had good earnings and beat expectations this whole time, but look at it going down, down, down. Why? Because small funds managers from the retail side were selling while the dark pools were slowly creating this bottom. And they slowed the selling down because they're long-term investors. I also heard someone tell me that, oh, the buy side fills the queues and was buying or selling before the market opens. Doesn't matter which one it is because it's totally untrue. Buy side does not participate in the pre-market activity at all. They are not short-term traders. They are long-term investors. They hold about 80 million families pension funds and are fiduciarily responsible to make those pension funds grow. And that's how they make their money. They charge for the services from your corporation or whomever you work for. If you have a pension plan, a 401k, an IRA, pension plan provided by your company, whatever, it's all your corporation isn't managing that. They don't have the skills. They turn that over to the buy side institutions. There's 100 or more pension funds that are private. You have Vanguard, it's private. Fidelity, it's private. Then you have another market participant group that is developing, and that is the global asset management companies. And that global asset management companies are BlackRock and State Street, and they have a totally different perspective on how they invest. They do a lot of short-term trading. They build a lot of ETFs. So do the buy side, but the buy side only provide them to their pension fund holders, you. So there's a completely different aspect. The sell side institutions, which are your money center banks and your what's left of the financial services industry, are short-term traders. That's all they do, and they enjoy selling short because they make a huge amount of money at it. So all of these dynamics are occurring, and a lot of it is occurring off of the public exchanges in ATS venues that you can't see. So 80% of all the market activity, some 350 to 400 billion dollars, changes hands every day in the US stock market, and that is building. It's not because there are more uh, retail traders or small lot investors. It's because there are more and more pension plans. The foundation of the stock market is built on the pension plans that the buy side dark pools manage, control, and make sure that the return on investment improves over time. So we're looking at this, and this is a cycle of market participants. The dark pools slow the selling down because this stock has been doing well as far as its earnings, and it beats its estimates. But for some reason, everybody on the small funds management side wanted to sell this retail. Okay, well, if you want to sell something, the market the market guarantees that for every seller there is a buyer, and for every buyer there's a seller. So if you want to sell something or you want to buy something, they're going to provide that service to you. They're not going to guarantee that you're going to make money. That is up to you. It's up to you and how you understand things. The buy sides always create the bottom, the dark pool buy zones. The pro traders create the nudges that start to trigger it to complete the bottom, which is right in here. Completion of the bottom from this stock is right in here. So they're pushing this up and they're nudging it. At some point, there'll be a gap. HFTs, gap at market open, the only market participant group that is capable of filling the queues in the morning before the market opens on a millisecond scale. That means 60,000 orders per second just before the market opens are the HFTs that are fully automated. The HFTs aren't programmed, and they're computers that automatically function. Boom, 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 boom. So they find out there's some sort of news or something that they figure is going to cause retail groups to react, and they fill the queues with small lot orders, forcing the computers of the market to gap the stock up, or conversely, gap it down. In this instance, they were gapping it up, but these pro traders nudges encouraged that HFT to gap up. Pro traders, there's 3 or 4 different types of professional traders: independent traders, traders who have a company that they provide the services of trading to, sell-side institutions, floor traders. Do you think that AI buys and sells for the sell-side institutions? No. Why do you think JP Morgan keeps snarling about its traders want to stay home and work from home, and it wants them back in the office? If AI was doing their work, they wouldn't say that. So it gaps it up. And there's a little nudge because people aren't so sure because there's some resistance here. And then it has a nice little swing style run up, and then a little resting day. Pro trader nudges. And then it has another run up. And then smaller funds start getting in. Smaller funds, smaller funds. Oh boy. And then all of a sudden there's a sell day. And a lot of people are selling. They're selling too soon. Another push to push this price up, and then more profit taking from pro traders, and then it keeps running up speculatively. Now, who's running it up speculatively? Buy side institutions? Nope. They stopped buying it way down here. Sell side institutions, well, they might be in the mix. Buybacks are big. It probably could also be a range of buybacks for PANW, which they did have. And this huge run candle, the volume is too low. So this is smaller funds managers. This isn't a horde of retail traders all rushing to buy the stock. One of the things that has been happening lately that is a problem is that the momentum, which is always created by retail traders, retail investors, foreign funds, sovereign funds, nonprofit funds, small asset management companies, small funds managers, small hedge funds managers, all of the retail side haven't been participating. And the retail news and all the companies that try to get you to buy, they've been pushing and pushing and pushing. Buy this, buy this, buy this. Oh, this is a great stock. Oh, this is a great stock. Well, it's already been running up, and at some point it's going to exhaust itself, and it did, and it came back down. Now, for swing trading support level, the support level is about right here. But at this point, are dark pools going to buy it? No, it's overpriced, it's overvalued. They always look at the fundamentals, and yes, they're going to hold it. They're going to sit and hold it. Yeah. Hey, until this company starts to show a sign of weakness or market saturation of its product or whatever, they'll hold. They're long-term investors. What about the banks? Well, the banks wanted to have this thing sell short more, and it didn't happen. So they're a little bit burned on that side. They don't always have profits on everything. They leverage heavily. So you have to be aware of that. There's a lot of going on in this market. It's not a herd mentality. And definitely we lacked, even though this stock moved up, I would say there's a lot of things going on that are pushing it that have nothing to do with retail. Retail investors have been paused and not anxious to be buying more stocks. One of the reasons is that their pension funds are doing excellent. So why should they worry about selling or anything like that? They've been told to hold to the 20% line. And if it goes below the 20% line, the dark pools are going to come in and boost that price. This is all pure speculation dominated by pro traders and small funds managers. And the pro traders are trading against the small funds managers. So when you hear the news and when you listen to the news, you have to go, oh, all the small investors, all the investors or Main Street are worried about this or happy about this or whatever. It's like, which one of them? Because there's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 different retail side. It's not all, they're not all trading exactly the same. They're not in the herd mentality. And your buy side institutions never, never, never speculate. They never trade short term. I'm Martha Stokes, and that's the topic for today.